Before we dive in, please remember that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information provided is not intended as financial, legal, or tax advice. You should consult with a qualified professional before making any financial decisions, especially those concerning insurance or investment products for your family. Alright, let's get into it. The mailer shows up on a random Tuesday. On the front, there's a picture of a baby so perfect, so impossibly cute, it looks like it was designed in a lab. The headline, in big, friendly letters, says something like, "Lock in a lifetime of protection for just pennies a day." And in that moment you feel it. That powerful primal instinct to do anything to protect that little person sleeping in the other room. Your first thought is, of course I want to protect their future. But then a second thought creeps in, a little quieter, a little more skeptical. Wait a minute. Life insurance for my kid? They don't have a job. They don't have a mortgage. Is this a scam? That single piece of mail sends millions of American parents into a spiral of confusion every single year. You're caught in a tug-of-war. On one side you have your heart screaming, do everything possible to keep them safe. On the other side you have your brain whispering, this feels a little weird. Is someone trying to sell me something I don't need? And it's not just the mail. Suddenly your world is flooded with it. It's the targeted ads that pop up on your social media feed 2 minutes after you Google best stroller. It's the well-meaning but maybe misinformed advice from your own parents who say, "Oh, we bought one for you when you were a baby." It's the constant, unavoidable presence of brands like Gerber Life, with their famous Grow Up plan, or Mutual of Omaha and Globe Life, all promising a financial head start for your child. They are absolute masters of emotional marketing. They tap directly into the anxieties of being a new parent. They use words like legacy, security, guarantee, and love. They know you're exhausted, overwhelmed, and trying to do the best you can. They paint a picture where buying this policy for $50 a month is the ultimate act of responsible parenting. A simple box you can check off your endless to-do list. And who doesn't want that feeling of, I did something good for my kid today? The problem is, this entire sales pitch is built on a foundation of feeling, not finance. They rarely talk about the math. They don't show you the internal fees or the dismal rate of return. They certainly don't put their products side by side with other financial tools designed for a child's future. They sell you on the feeling of security, but they get incredibly vague about the actual financial utility. This leaves you, the parent, stuck in a vulnerable position. You're being asked to make a major long-term financial decision based on a 30-second commercial and a cute baby. You're left asking, is this a genuine financial planning tool? Or is it an overpriced, low-return product wrapped in a pretty bow? Is it a brilliant move that sets my child up for life? Or am I just paying for peace of mind that I could get for free? Here's the brutal, honest truth that the insurance companies will never tell you. Buying life insurance for your child is one of the most polarizing decisions in personal finance. There is almost no middle ground. It is either one of the biggest financial blunders you can make as a parent, a complete waste of money that could have been used to build real wealth for your child, or it is one of the most sophisticated, multi-generational wealth building and protection strategies you could ever implement. The difference between those two outcomes, costly mistake versus financial masterstroke, depends entirely on why you're buying it, which type of policy you choose, and how you structure it. And that is exactly why this video exists. We are going to arm you with the unbiased, unfiltered information you need to make the right call for your family. We're going to take this confusing, emotionally charged topic and make it simple. By the time you finish watching, you will not have any more questions. You will have a clear, definitive answer. You will know with 100% certainty whether child life insurance is a yes or a no for your specific situation. You'll be able to see that mailer, that ad, or that sales pitch and know instantly whether to engage or to throw it straight in the trash. To do that, we're going on a comprehensive deep dive. We're not just scratching the surface, we're excavating the entire topic. First, we're going to expose the 3 main reasons insurance agents and companies push these policies so hard. We'll separate the legitimate benefits from the misleading sales tactics. You need to understand their playbook, their scripts, and their psychological triggers to make an informed choice. Second, we're going to break down the 2 fundamental types of child life insurance, term and whole life. This is the single most important fork in the road. We'll explain them in plain English, and I'll tell you why one of these is almost always a terrible deal for 99% of American families, The other has a hidden financial superpower that most people, even some financial advisors, don't fully understand or know how to use correctly. Third, we will unpack that superpower. The cash value component inside a whole life policy. This is where the real debate lies. We'll explore exactly how it grows, how it's sheltered from market downturns, and how you can access it completely tax-free through policy loans. We'll talk about how this cash value can become a private family bank that your child can use for anything. A down payment on their first home, seed money for a business, a wedding, or even to supplement their own retirement decades down the line. This is the secret weapon argument for child life insurance, and we're going to put it under a microscope to see if it holds up. Fourth, we'll tackle the guaranteed insurability argument. This is a big one. They tell you to buy a policy now to protect your child's ability to get insurance as an adult, in case they develop a health condition like diabetes or asthma. Is this a legitimate risk you need to hedge against? Or is it an emotional scare tactic designed to prey on your deepest parental fears? We'll look at the actual data, the real-world odds, and the alternative ways to secure their future. Finally, and most importantly, we are going to run the numbers. This is where the truth comes out. We'll do a head-to-head, no-holds-barred comparison. We'll take the exact premium, say $50 a month, that you would spend on a typical whole life policy for a child. Then we'll see what happens if you invest that same $50 instead in a $529 college savings plan, a custodial Roth IRA, or a simple S&P 500 index fund. We'll project it out 20, 40, even 60 years, so you can see the staggering life-altering difference a simple decision today can make for their entire financial future. No opinions, just data. This will show you the true opportunity cost and help you see which path creates the most wealth for your child in the long run. This is the definitive guide you've been looking for. No fluff, no sales pitch, just clarity. So let's get started. To truly understand this product, we have to first understand the psychology behind why it's sold. Let's pull back the curtain on the insurance industry's sales machine. The number one reason parents end up buying a policy they don't need or don't understand comes down to a single, tragic, and deeply emotional argument. It's the argument that no parent ever wants to think about, but it's the one that insurance marketers know is their most powerful tool. And it revolves around covering the costs of the unthinkable. A funeral. The average cost of a funeral in the United States, according to the National Funeral Directors Association, hovers between $7,000 and $12,000. But that's just the average. In many states, especially in urban areas, you can easily be looking at $15,000 or more. Let's break that down because the numbers are staggering when you see them laid bare. You have the non-declinable basic services fee from the funeral home, which is often $2,000 to $3,000 right off the top. Then there's the casket. A simple, modest casket can cost $2,000, while more elaborate ones can soar past $10,000. Then you have the burial plot, the vault or grave liner that many cemeteries require, the cost to open and close the grave, the headstone or marker, the hearse, the flowers, the memorial service itself. Each one is another line item. Another bill that arrives during the single worst period of a parent's life. And that's just the direct costs. The indirect costs are what can truly devastate a family financially. Most American workers don't have extensive bereavement leave. If the unthinkable happens, how much time would you need to take off work? A week? A month? 6 months? For many, the answer is as long as it takes. But that lost income is a brutal secondary blow. You're grieving, you're shattered, and now you're staring at a mountain of bills with no paycheck coming in. Add to that any final medical expenses that might not be covered by health insurance, and the cost of therapy and grief counseling for you, your partner, and any other children in the family. This is the scenario that the insurance agent paints. And it's a terrifyingly effective one. They present a child life insurance policy, often for a small monthly premium, say $20, $30, or $40 a month, as the ultimate safety net. For the price of a few cups of coffee, they say you can buy peace of mind. You can ensure that if the one-in-a-million tragedy strikes, you will have a tax-free check for $10,000, $20,000, or $50,000 land in your bank account. Money that allows you to pay for everything without a second thought. Money that allows you to take the time you need to grieve without worrying about the mortgage. Money to create a memorial, a scholarship fund, or a charitable donation in your child's name. They frame it not as a financial instrument, but as an act of responsible love. A way to protect your family from financial ruin on top of emotional devastation. And when you're a new parent, sleep-deprived and wired to protect your child from every conceivable threat, that argument can feel almost impossible to refuse. It seems like the most responsible thing in the world to do. But is it? Let's step back from the emotion for a moment and look at this from a purely financial perspective. The core question is this: is a separate life insurance policy the most efficient way to protect against these specific, low-probability, high-impact costs? For most financial experts, the answer is a resounding no. The alternative is something you probably already have or should have: an emergency fund. A fully funded emergency fund, typically 3 to 6 months of living expenses, is designed for exactly this kind of catastrophic, unforeseen event. If you have $20,000 sitting in a high-yield savings account, you are already self-insured against the risk of funeral expenses. You have the cash on hand to cover not only the funeral but also the lost wages and other ancillary costs, without paying a monthly premium to an insurance company for the privilege. But wait, you might say, I don't have a $20,000 emergency fund yet, and that insurance premium is only $30 a month. Isn't that a good deal in the meantime? It's a fair question, but let's run the numbers. Let's say you buy a whole life policy for your newborn with a $30 monthly premium. Over 18 years, you will have paid $6,480 in premiums. That policy might have a cash value of, if you're lucky, a few $1,000s by then. Now, what if you instead took that same $30 a month and invested it in a simple low-cost S&P 500 index fund? Assuming a conservative average annual return of 8%, by the time your child turns 18, that account would be worth over $14,000. That's more than double what you paid in, and it's money that is liquid, accessible, and belongs entirely to you and your child, not to an insurance company. The argument here is that the money you'd spend on premiums is almost always better used to build your own financial fortress, paying off high-interest debt, building your emergency fund, and investing for your own retirement and your child's future. But I get it. For some parents, that logic doesn't erase the fear. The idea of not having a dedicated financial tool for that one specific, horrible risk is still unsettling. For those parents, there is a much cheaper and more efficient solution that most insurance agents selling those pricey whole life policies conveniently forget to mention. It's called a child rider. A child rider is not a separate policy. It's an add-on to your own term life insurance policy. The policy you absolutely should have to protect your children if something happens to you. For an almost laughably small cost, often just $5 or $6 a month, you can add a rider that provides a modest death benefit, typically $10,000 to $20,000, for any and all of your children. Let me repeat that. For about the price of one latte a month, you can get a rider that covers your first child, your second child, and any future children you have, usually up until they're about 25 years old. It provides just enough money to cover those final expenses we talked about, giving you that specific peace of mind without forcing you into an expensive, low-return whole life product. It is, for the vast majority of parents who feel they need this coverage, the single best way to get it. It addresses the emotional need without derailing your broader financial goals. So, if an emergency fund is better, and a child rider is a vastly cheaper alternative, why on earth are standalone life insurance policies for kids still so popular? Why do agents push them so hard? This brings us to the second and far more insidious argument for buying your child life insurance. It has nothing to do with funerals or final expenses. Instead, it's pitched as a brilliant financial gift, a way to lock in their future. They call it guaranteed insurability. The pitch is this: what if your child develops a medical condition later in life? Something like juvenile diabetes or asthma or a heart condition. That condition could make it difficult or even impossible for them to qualify for affordable life insurance when they're an adult with a mortgage and a family of their own to protect. But, the agent will say with a confident smile, if you buy this policy for them now while they are young and perfectly healthy, you lock in their insurability for life. They are guaranteed the right to buy more coverage in the future, regardless of their health. You're not just buying a policy. You're buying your child a ticket to a secure financial future that no illness can ever take away. Sounds incredible. A financial superpower you can pass down to your child. But is this promise of guaranteed protection a golden ticket? Or is it a golden cage? The truth is far more complicated, and it hides a trap that can end up costing your child tens of thousands of dollars down the road. The trap isn't written in the fine print. It's hiding in plain sight, disguised as a feature. It's called opportunity cost, and it's the silent killer of wealth. When an insurance agent sits at your kitchen table, they'll paint a beautiful picture using words like guarantees, cash value, and a legacy. What they conveniently leave out is a breakdown of where your money actually goes in the critical early years. See, when you pay the premium for a whole life insurance policy for a child, a huge chunk of that money, especially in the first few years, doesn't even touch the cash value savings account. So where does it go? It goes to the insurance company's overhead and, most significantly, to the agent's commission. We're talking about a massive percentage, often as high as 50 to 100% of your first year's premiums. So, for the first year or two, you're essentially just paying the person who sold you the policy. The growth on your investment is starting from a deep, deep hole. Compare that to almost any other investment vehicle. If you put money into a 529 college savings plan or a simple index fund, nearly 100% of your money goes to work for you from day one, minus some incredibly small administrative fees. With whole life, you're starting the race a full lap behind everyone else. And then there's the growth itself. The guaranteed rate of return on the cash value in these policies is notoriously low. Historically, you're looking at something that might barely keep up with inflation if you're lucky. They'll show you complex charts with non-guaranteed dividends. But these are often wildly optimistic projections that depend entirely on the insurance company's profits. They are not a promise. They are a sales tool. So you have high upfront costs and slow, anemic growth. This is the mechanism of the trap. But to truly understand its devastating impact, let's tell a story. Meet two families, living next door to each other on a quiet suburban street. We'll call them the Millers and the Johnsons. Both have a newborn baby. Both are loving, responsible parents who want to give their child the best possible start in life. Both decide to set aside $50 a month for their child's future. That's $600 a year. The Millers meet with a friendly insurance agent who sells them on the dream of guaranteed insurability and a forced savings plan. They sign up for a whole life insurance policy for their baby Sarah. They diligently pay their $50 premium every single month, feeling proud that they're doing the responsible thing. The Johnsons, on the other hand, do a little research. They realize that the chance of their baby, Ben, needing life insurance is astronomically small. Instead of buying an insurance product, they decide to invest that same $50 a month. They open a custodial investment account and put that $50 every month into a simple, low-cost S&P 500 index fund. This fund just mirrors the performance of the 500 largest companies in America. No fancy sales pitches, just steady, disciplined investing. Now let's hit the fast-forward button. 18 years fly by. Sarah and Ben are both graduating high school and thinking about college, a car, or starting their adult lives. First, let's look at Sarah Miller's whole life policy. The Millers have paid $50 a month for 18 years. That's a total of $10,800 in premiums. They check the policy's statement, the cash surrender value. The money they can actually take out is, let's say, $13,000. It grew, sure. But remember, a huge chunk of their early payments went to fees and commissions. The growth was slow and plodding. They're happy they have something, but they don't know what they've missed out on. Now let's knock on the Johnsons' door. They also invested $50 a month for a total of $10,800. But their money wasn't being eaten by commissions or sitting in a low-yield insurance product. It was in the stock market, harnessing the power of the American economy through an S&P 500 index fund. Over the last few decades, the historical average annual return for the S&P 500 has been around 10%. Let's be conservative and say Ben's account averaged an 8% annual return over those 18 years. What does his account look like? It's not $13,000. It's not even $20,000. Ben Johnson's account is worth over $25,000. Let that sink in. Same money in. Same time frame. Same discipline. One family chose a product sold as safe and guaranteed. The other chose a straightforward investment. The difference is nearly double the money. That $12,000 difference is the cost of a reliable used car. It's a full year of tuition at a state university. It's a life-changing amount of money for an 18-year-old. That is the opportunity cost. It's the ghost of the wealth that could have been. Every dollar you put into a high-fee, low-return product is a dollar that isn't working hard for your child's future. The Millers didn't lose money, technically, but they lost an opportunity. Their money was in a cage, growing slowly, while the Johnsons' money was out in the open, compounding and sprinting ahead. Now the insurance agent would jump in here and say, "But wait, what about the death benefit? Sarah was insured for $100,000 this whole time. Ben had no protection." And my question to that is, protection from what exactly? The primary purpose of life insurance is to replace lost income, to protect dependents who rely on your paycheck to live. A child has no income. They have no dependents. The financial devastation of a child's passing, and I can't even begin to imagine the emotional devastation, is not from a loss of income. It's the funeral expenses, medical bills, and time off work for the parents to grieve. A basic term life insurance rider on your own policy can cover these final expenses for a child for just a few dollars a month. Pennies on the dollar compared to a whole life premium. You can get a $10,000 or $20,000 rider that provides more than enough to cover those tragic costs, without sacrificing your child's financial future on the altar of an expensive, inefficient investment product. You are paying a massive premium for a benefit, the death benefit, that you have a 99.9% chance of never, ever using. And the price you pay is crippling the growth of their nest egg. This is the golden cage in its full tragic glory. You're handed a key to a policy that feels safe. It has guarantees. It has the words life insurance on it, which sounds responsible. But you are locking your child's money away, sentencing it to a lifetime of slow growth. When Sarah turns 18, she's handed this policy with its meager $13,000 cash value. She might keep paying into it because that's what her parents did. She's trapped by the sunk cost fallacy, thinking, well, we've put so much in already, I can't stop now. She doesn't realize that the very same policy her parents thought was a gift is now the anchor weighing down her own financial journey. She's paying for life insurance she likely doesn't need yet, with money that could be invested far more productively. The Johnsons, on the other hand 18-year-old Ben an investment account with over $25,000. He has a real tangible Headstart. He can use it for a down payment on a house in his 20s. He can let it continue to grow, letting compound interest work its magic, potentially turning it into hundreds of thousands of dollars by retirement. He has options. He has freedom. Sarah has a bill and a ball and chain. So the numbers are clear. The opportunity cost is massive, but the financial cost is only half the story. The real danger lies in how these policies are sold, the promises they make, and the psychological blind spots they exploit in loving parents. What they don't tell you in the sales pitch is that this policy could actually cripple your child's financial future in ways you can't even imagine yet, ways that go far beyond just a smaller bank account. And that's what we need to expose next. The first and perhaps most devastating hidden trap is something called the Free Application for Federal Student Aid, or FAFSA. If you have kids in the United States, you've probably heard of it. It's the form every family fills out to determine how much financial aid their child is eligible for when they go to college. The government looks at your income, your assets, and your child's assets to calculate something called the Expected Family Contribution, or EFC. The lower your EFC, the more aid you're likely to get: grants, scholarships, subsidized loans. The higher your EFC, the more you're expected to pay out of pocket. Now, here's the critical part they never mention in the glossy brochure for your kid's whole life policy. The FAFSA treats assets in a parent's name differently from assets in a child's name. Retirement accounts like your 401k or IRA, they aren't even counted as assets. A 529 college savings plan, which is owned by the parent for the child's benefit, it's assessed at a maximum of just 5.64% of its value. So, if you have $10,000 in a 529 plan, it might increase your expected family contribution by, at most, $564. It's not ideal, but it's manageable. But a whole life insurance policy with cash value, taken out in your child's name? That cash value is considered an asset of the child. And the FAFSA assesses a child's assets at a whopping 20%. Let me say that again. Not 5%, 20%. Let's make this real. Imagine two families, the Smiths and the Joneses. Both have a daughter turning 18 and heading to college. For the last 18 years, both families diligently saved $100 a month. The Smiths put their money into a whole life policy for their daughter, which now has a cash value of, let's be generous and say, $25,000. The Joneses put their money into a 529 college savings plan, and with modest market growth, it's now worth $50,000. When the Joneses fill out the FAFSA, their $50,000 529 plan is assessed at the parent rate of 5.64%. This increases their expected family contribution by about $2,820. Now it's the Smiths' turn. Their daughter's whole life policy has a cash value of $25,000. Because it's considered her asset, it gets hit with the 20% assessment rate. 20% of $25,000 is $5,000. This means their expected family contribution goes up by $5,000. Let that sink in. The family that saved half as much money in the wrong vehicle is penalized almost twice as much. And this isn't a one-time penalty. This happens every single year they apply for financial aid. Over 4 years of college, That whole life policy could single-handedly reduce their daughter's financial aid eligibility by $20,000. The very gift that was supposed to secure her future is now actively sabotaging her ability to afford an education. You've essentially been paying an insurance company for the privilege of disqualifying your own child from thousands of dollars in grants and scholarships. It's a financial self-immolation, and the insurance agent who sold it to you is nowhere to be found when the tuition bills arrive. But the cruelty of this trap goes even deeper. You might think, well, at least my child has this $25,000 asset they can use. But can they? Until your child reaches the age of majority, 18 or 21 depending on your state, they are not the owner of the policy. You are. The parent is the owner. The child is just the insured. So for FAFSA purposes, it's the child's asset that gets punished at the 20% rate. But in reality, the child has zero legal control over that money. They can't access it. They can't borrow against it. They can't surrender the policy. It exists in the worst of all financial worlds. It carries the liability of being their asset, without providing them any of the control or access. It's a phantom asset that does very real damage. This brings us to the second crippling mechanism, the surrender charge. Let's say you watch this video, you have a horrifying moment of realization, and you decide you want out. You call up the insurance company and say, "I've made a terrible mistake. I want to cancel this policy and get my cash value back." The person on the other end of the line will politely inform you that you are welcome to do so, but it's going to cost you a lot. These policies are built with massive penalties for anyone who tries to leave early. These are called surrender charges. For the first several years of the policy, the surrender charge can be as high as 100% of the cash value you've built. That means if you cancel, you get nothing back. Zero. All those premiums you paid? Gone. These charges typically last for 10 to 15 years, slowly decreasing over time. In year 8, you might still forfeit 30 or 40% of your cash value just to get your own money back. The insurance company has built a financial prison. They sold you on the idea of a safe, secure place for your money to grow, but what they actually built was a vault that's easy to put money into, but incredibly painful and expensive to take money out of. It's a one-way street. They lock you in with these surrender charges, counting on the fact that the pain of losing so much money will force you to keep paying premiums on a terrible product. They are holding your child's financial future hostage, and the ransom is a percentage of your own savings. So now we see the full picture of this financial nightmare. First, you have the astronomical opportunity costs we talked about before, the tens or even hundreds of thousands of dollars in lost growth compared to a simple index fund. You're already starting the race 50 yards behind the starting line. Second, you have the FAFSA trap. The small pile of cash you've managed to accumulate in the policy is now actively working against your child, potentially costing them tens of thousands of dollars in college aid, forcing them to take on more student loan debt. The gift has become a liability. And third, when you finally realize the trap you're in, the surrender charges act like prison bars, making it financially devastating to escape. You are punished for buying the policy, and you are punished for trying to cancel it. Every single one of these mechanisms benefits the insurance company at your direct expense. They feast on the high fees and commissions. They feast on the massive spread between what they earn on your money and the pitiful interest they credit to your account. And they feast on the surrender charges from families who can no longer afford the premiums or who simply wise up to the game. It's a system designed from the ground up to transfer wealth from your pocket to theirs, all under the guise of protecting your child. It seems like a completely open and shut case, a financial disaster on every level. So why, then, do millions of well-meaning parents still buy these policies? Because the insurance industry has a trump card. They have a powerful, emotionally charged argument that they use to override all of this logic. It's an argument that preys on a parent's deepest fears. And understanding how they weaponize this fear is the absolute key to protecting yourself and your family from making this catastrophic mistake. So what is this silver bullet argument? It's called the unthinkable. The agent sits across from you, maybe at your own kitchen table. They've just explained the confusing mechanics of the policy, the cash value, the dividends. They can see your eyes glazing over. They know the logic isn't landing, so they pivot. They lean in, their voice drops to a sincere, somber tone, and they ask a question designed to stop your heart. Imagine just for a second, the unthinkable happens. Your child is gone. In the midst of that unimaginable grief, the last thing you want to worry about is money. How would you even afford a proper funeral? How could you possibly go back to work the next week or the next month? This policy, This small payment is not about investment. It's about giving you the space to grieve. It's peace of mind. And just like that, the conversation is no longer about numbers. It's not about compound interest or opportunity cost. It's about love. It's about grief. It's about your identity as a protector, as a parent. To say no in that moment feels like saying you don't care enough. It feels like you're betting against your child's life, or worse, that you're admitting you couldn't handle the financial fallout of the worst day of your life. It is a psychologically perfect sales pitch. And it is a complete and utter distortion of financial reality. Let's pull this argument out of the realm of emotion and into the light of day. Let's break it down piece by painful piece. First, the cost of a funeral. This is a real, tangible expense. According to the National Funeral Directors Association, the median cost of a funeral with a viewing and burial is around $7,800. For a child, it can sometimes be less, maybe in the range of $5,000 to $10,000. This is a significant amount of money that most families don't have just sitting around. So the salesperson's point seems valid. A $10,000, $20,000, or $50,000 death benefit would certainly cover this. Second, the cost of taking time off to grieve. This is also a very real financial concern. In the face of such a loss, you wouldn't be able to function at work. You would need weeks, maybe months. Let's say both parents take 3 months off. If the median household income in the US is around $75,000, 3 months of lost income is about $18,750. So, add the funeral cost and we're looking at a total financial impact of, let's say, $25,000 to $30,000. So when an agent presents you with a $50,000 policy for your child, it seems to perfectly solve this $25,000 to $30,000 problem. The math appears to add up. The logic seems sound. But this is the critical illusion. You are being sold an incredibly expensive, inefficient, and restrictive solution to a problem that has a much better, cheaper, and more flexible answer. That answer is the single most important financial tool for any family: a fully funded emergency fund. An emergency fund is simply 3 to 6 months of your essential living expenses, saved in a liquid high-yield savings account. It's not invested in the stock market. It's not locked away in a complicated insurance product. It's your money sitting there waiting. Its job is to be a financial shock absorber for your life. If you lose your job, the emergency fund covers your mortgage and groceries. If your transmission blows, the emergency fund pays for the repair. If a medical crisis hits, the emergency fund covers the deductible. And yes, if the absolute unthinkable happens, the emergency fund is there to cover funeral costs and lost wages, immediately, with no paperwork, no claims process, and no waiting for a check from an insurance company. Think about the difference. To get the life insurance payout, a grieving parent has to call the insurance company, get a death certificate, fill out extensive paperwork, and then wait weeks, sometimes months, for the claim to be processed and paid out. With an emergency fund, the money is available the same day. You walk into your bank or transfer it online. The liquidity is absolute. But the most important difference is efficiency. Let's say you have a $30,000 emergency fund. That single pile of money protects you from a near infinite number of potential disasters. It protects you from job loss, from disability, from a leaky roof, from a lawsuit, from a sick parent, and also from the statistically microscopic risk of needing to bury your child. A $50,000 child life insurance policy protects you from exactly one of those things. It is the financial equivalent of buying a different, specialized, and very expensive fire extinguisher for every single room in your house, when what you really need is one good, reliable sprinkler system that protects the whole building. Now, I can hear the objection already. But that's great for people who have a $30,000 emergency fund. I don't. I'm living paycheck to paycheck. That's why the $30 a month policy seems so attractive. It's the only protection I can afford. This is the final, most insidious part of the trap. The salesperson presents the policy as a substitute for real savings. They frame it as a responsible choice for those without a safety net. But the truth is the exact opposite. That $30 a month premium is not your safety net. It is the very thing preventing you from building one. That $30 or $360 a year is money that should be going directly into a high-yield savings account. It is the seed for your emergency fund. In 5 years, that's $1,800 plus interest. In 10 years, it's $3,600. It's a start. It's real. It's yours. Paying for a child life insurance policy when you don't have an emergency fund is like being a thirsty person in the desert who spends their last dollar every month on a single, expensive bottle of water that they're not allowed to drink unless they get struck by lightning. It makes no sense. The priority is to find an oasis. The priority is to build the emergency fund. Every dollar spent on that policy is a dollar that delays your journey to true financial security. It keeps you dependent on their product by siphoning away the very resources you need to become financially independent. The emotional argument about the unthinkable is powerful because it taps into our deepest instincts as parents. But it is a manipulation. It creates a false dilemma, suggesting that this niche insurance product is the only way to navigate a tragedy. The reality is that building a strong financial foundation for your family, starting with a robust emergency fund, is the most loving, responsible, and effective way to protect them from all of life's potential catastrophes, including the ones we dare not speak of. It replaces a manufactured peace of mind with genuine financial resilience. So we've dismantled the fear-based sales pitch. But what about the argument that you're locking in your child's future? That you're guaranteeing they can get insurance later in life no matter what health problems arise? This future insurability argument sounds incredibly responsible. Sounds like great parenting. But is it? Or is it just another financial trap? Dressed up in the language of love and protection? We're about to find out. The biggest weapon in the insurance agent's arsenal is fear. Not the fear of your child dying, but a far more subtle, more sophisticated fear. The fear of an uncertain future. The fear that your child, through some cruel twist of fate, develops a condition like juvenile diabetes or a heart murmur, and is later denied the life insurance they need as an adult to protect their own family. It's a powerful emotional trigger, because what parent wouldn't pay a small price today to protect their child from a major roadblock tomorrow? Let's dissect this. The promise is that by buying a policy now while your child is young and healthy, you lock in their insurability for life. It's presented as a guarantee. But what are the actual odds of a child developing a condition that makes them completely 100% uninsurable as an adult? The numbers are stunningly low. While exact statistics are hard to pin down because they're spread across countless conditions, the vast majority of people in the United States are insurable. Modern medicine and a competitive insurance market mean that even individuals with pre-existing conditions can often get coverage, though it might be more expensive. The idea of being permanently locked out of the system is an edge case, a statistical rarity. Insurance companies have built a multi-billion-dollar industry by getting us to focus on the 1 in a million chance, instead of the 999,999 other, more probable outcomes. They are masters at making the unlikely seem inevitable. Think about it. You are far more likely to need that money for a broken arm, braces, or an unexpected car repair than you are to need it to hedge against the remote possibility of future uninsurability. The insurance company is betting on statistics. They know the odds are overwhelmingly in their favor. The question is, why aren't you betting on those same odds? This ties directly into the second big selling point. Lock in a low premium for life. An agent might show you a quote. Look, just $25 a month. For that price, you can guarantee your son has a $50,000 policy for the rest of his life. That rate will never go up. On the surface, it sounds like a bargain. But this is where we have to talk about two silent wealth killers: opportunity cost and inflation. First, opportunity cost. That $25 a month doesn't exist in a vacuum. Every dollar you give to the insurance company is a dollar you can't put somewhere else. $25 a month is $300 a year. Over 18 years, that's $5,400 in payments alone. Now, what if instead of giving that money to an insurance company for a product your child doesn't need, you invested it? Let's be conservative. Let's say you put that $25 a month into a simple low-cost S&P 500 index fund. Historically, the stock market has averaged around a 10% annual return. Over 18 years, that $5,400 you paid in premiums could have grown to over $15,000. By the time your child is 30, it could be worth over $40,000. By age 50, it could be over $250,000. All from that same $25 a month. That is the opportunity cost. You're not just losing the premium. You're losing all the growth that money could have generated for decades. Second, inflation. That $50,000 death benefit sounds okay today. But what will it be worth in 40, 50, or 60 years when your child might actually need it? Assuming an average inflation rate of just 3% in 50 years, that $50,000 policy would have the purchasing power of only about $11,000 in today's money. It would barely be enough to cover a funeral, let alone provide any meaningful support for their family. So you've locked in a low premium, yes, but you've also locked in a death benefit that is guaranteed to shrink in value every single year. This is where the conversation usually shifts. The agent, sensing you understand the flaws in the basic policy, will introduce the crown jewel of their pitch: cash value. This is the Trojan horse of child life insurance. They'll say, but this isn't just a death benefit, it's a whole life policy. It's a savings and investment vehicle, all in one. It builds cash value that grows tax-deferred. You can borrow against it for a down payment on a house, or even to pay for college. This is, without a doubt, the most misleading part of the entire sales pitch. Let's be perfectly clear. A whole life insurance policy is one of the worst investment vehicles ever created for the average person. The cash value is not your friend. Here's why. First, the returns are abysmal. The growth they promise is often eaten alive by enormous fees, administrative costs, and the agent's commission, which can be as high as 100% of your first year's premiums. For the first several years of the policy, your cash value might be zero or close to it, because all your money is going to paying the insurance company and the person who sold it to you. The guaranteed growth rate on these policies is often a paltry 1 to 2%, far below the rate of inflation, meaning your money is actively losing purchasing power over time. To see how devastating this is, let's imagine two families. The Wilsons and the Garcias. Both have a new baby. Both decide to put away $100 a month for their child's future. The Wilsons meet with an insurance agent who sells them a $100,000 whole life policy with a cash value component. He tells them it's a brilliant way to save for college. The Garcias, on the other hand, open a $529 college savings plan, a state-sponsored investment account specifically designed for education, and they invest their $100 a month in a simple target date fund. For the first few years, the Wilsons see almost no growth in their cash value. The fees and commissions are just gobbling it all up. Meanwhile, the Garcias 529 plan is compounding, taking advantage of market growth. Fast forward 18 years. The Wilsons check their policy. Their cash value, after paying in $21,600, might be worth around $25,000 if they're lucky. They feel pretty good about it. Then they talk to the Garcias. The Garcias also paid in $21,600, but their 529 plan, growing at a modest average of 8%, is now worth over $48,000, nearly double what the Wilsons have. And the money in the 529 plan can be withdrawn completely tax-free for qualified education expenses. The Wilsons, realizing their mistake, decide to cash out their policy to use the money for college. But then they get hit with another nasty surprise: surrender charges. If you cancel the policy, especially in the first 10 to 15 years, the company keeps a significant chunk of your money as a penalty. And if they want to borrow against the cash value instead, they have to pay interest to the insurance company to borrow their own money. But here is the single most misunderstood and outrageous detail about cash value. For most policies, when your child eventually passes away, their beneficiaries don't get the death benefit plus the cash value you spent a lifetime building. No, the insurance company pays the death benefit, and they keep the cash value. Let that sink in. You meticulously paid premiums for decades, building up this savings account inside the policy, only for that money to vanish back into the insurance company's pockets upon death. It was never truly your money. It was more like collateral for a loan against the death benefit. So if the future insurability argument is built on a statistical improbability, the low premium is an illusion shattered by opportunity cost and inflation, and the cash value is a high-fee, low-return investment trap, is there any reason for a parent to buy this? The answer, surprisingly, is yes. But it applies to an incredibly small, specific sliver of the population. And for the other 99% of us, there are far, far better ways to secure your child's financial future. And that's exactly what we're going to break down next. So let's start with the most common reason an insurance agent will push a whole life policy for a child: the cash value component. They'll call it a forced savings plan, a tax-advantaged investment, a way to build a nest egg your child can borrow against later for college or a down payment on a house. And on the surface, that sounds reasonable. But it's like trying to win a Formula One race with a minivan. Sure, the minivan has 4 wheels and an engine, and it will eventually get you to the finish line. But you're paying for a bunch of features you don't need for the race, like cup holders and sliding doors, and it's going to be ridiculously slow, inefficient, and expensive compared to the specialized high-performance vehicles designed specifically for that purpose. The 529 plan, the custodial Roth IRA, and the UTMA/UGMA account are those high-performance vehicles. They are built for one primary purpose: to grow your money as efficiently and powerfully as possible. Let's start with the first one, the 529 College Savings Plan. You've probably heard of it, but you might not realize just how much of a powerhouse it has become. A 529 is a state-sponsored investment account where your money grows completely tax-free, and you can withdraw it completely tax-free, as long as you use it for qualified education expenses. This isn't just college tuition. We're talking room and board, computers, textbooks, fees, supplies, even up to $10,000 in student loan repayments. Some states even give you a state income tax deduction for your contributions. That's a triple tax advantage. It's one of the best deals in the entire tax code. Think about the difference. When you put money into the cash value of a whole life policy, it's like planting a seed in a tiny pot with mediocre soil. The insurance company takes a huge chunk of your early contributions for commissions and fees, stunting the growth from day one. Then, the money grows at a slow, guaranteed rate, often barely keeping up with inflation. When you put that same money into a 529 plan, it's like planting that seed in a state-of-the-art hydroponic greenhouse. There are no sales commissions. You can invest in low-cost, broad market index funds that give you the potential for real, substantial growth over time. And because that growth is tax-deferred and the withdrawals are tax-free, you don't have the government constantly trimming the leaves. Every dollar of growth is yours to keep, compounding year after year into a much larger sum. For decades, the biggest fear parents had about the 529 was, but what if my kid doesn't go to college? Or what if they get a full scholarship? It was a legitimate concern. If you pulled the money out for a non-qualified reason, the earnings would be subject to income tax and a 10% penalty. But that all changed. Thanks to the Secure 2.0 Act passed in 2022, the biggest weakness of the 529 plan was transformed into one of its greatest strengths. Here's the new rule, and it is a complete game changer. As of 2024, if you have money left over in a 529 plan, you can roll it over tax-free and penalty-free into a Roth IRA for the very same beneficiary, your child. There are a few conditions. The 529 account has to have been open for at least 15 years, and the rollovers are subject to the annual Roth IRA contribution limits. There's also a lifetime rollover maximum of $35,000. Let that sink in. The absolute worst-case scenario for a 529 plan is no longer a penalty-ridden withdrawal. The worst-case scenario is now that you give your child a $35,000 tax-free retirement head start. You've essentially created a financial safety net that can pivot from funding their education to funding their retirement. A whole life policy can't do that. It doesn't have that flexibility. It's a one-trick pony, and its one trick is slow, expensive, and loaded with fees. The 529 plan is now a flexible, adaptable financial multi-tool. But what if you want to give your child an even more direct and powerful head start on retirement? That brings us to our second alternative, the custodial Roth IRA. This is, without a doubt, the single greatest wealth-building tool you can ever give a young person. There is one simple requirement: your child must have earned income. This doesn't mean a full-time job. It can be from babysitting, mowing lawns, lifeguarding over the summer, working a few hours a week at a local shop, any legitimate work where they are paid. If they have earned income, you can open a custodial Roth IRA in their name and contribute up to the amount they earned for the year, not to exceed the annual IRA limit. And this is where the magic of compounding unleashes its full, awesome power. Let's imagine your son Michael is 15. He gets a summer job and earns $3,000. You help him put that entire $3,000 into his new custodial Roth IRA, invested in a simple S&P 500 index fund. Now, let's say he never contributes another dime for the rest of his life. He puts that $3,000 in at 15 and forgets about it. Assuming an average historical market return of, say, 9% by the time Michael is 65, that single $3,000 contribution could grow to over $225,000. And every single penny of that is completely 100% tax-free. Now, compare that to putting $3,000 into a whole life policy. After 50 years, the cash value might be $20,000 or $30,000 if you're lucky. It's not even in the same universe. A custodial Roth IRA gives your child's money a 50-year runway for tax-free compounding. It is the financial equivalent of launching a rocket into orbit, while the whole life policy is like trying to get there by climbing a ladder. Both are forms of upward movement, but the results are vastly, astronomically different. So, the 529 is a superstar for education with a fantastic retirement backup plan. The custodial Roth IRA is a rocket ship for retirement, provided there's earned income. But what if you want ultimate flexibility? What if you want to build a fund for your child that they can use for anything? A car at 18, a down payment on a house at 25, a business venture at 30. That's where our third alternative comes in. The UTMA or UGMA account. The Uniform Transfers to Minors Act or Uniform Gifts to Minors Act. These are just fancy names for a standard custodial brokerage account. You open it, you fund it, and you manage the investments on behalf of your child until they reach the age of majority in your state, which is typically 18 or 21. The beauty of the UTMA/UGMA is its simplicity and flexibility. There are no income requirements like a Roth IRA. There are no contribution limits. And there are no restrictions on how the money can be used, unlike a 529. You can invest in the same low-cost index funds and let it grow over time. However, this flexibility comes with two major trade-offs you need to understand. First, it's not tax-advantaged like a 529 or a Roth. The investment gains are taxable. Now, there are some protections. The first $1,000 or so of earnings each year are typically tax-free, and the next $1,000 are taxed at the child's low rate. But after that, the kiddie tax rules kick in, and the gains are taxed at the parent's higher marginal tax rate. So it's less tax efficient. The second, and arguably bigger, trade-off is control. The moment your child hits the age of majority, 18 or 21, that account is legally theirs. All of it. You no longer have any say in how it's spent. If you've diligently saved $100,000 in that account, and your newly minted 18-year-old decides to spend it all on a flashy car and a trip around the world, there is nothing you can do to stop them. The money is theirs free and clear. For some parents, that loss of control is a deal breaker. For others, it's seen as an important lesson in financial responsibility. So we have three vastly superior alternatives. The 529, a tax-free education and retirement hybrid. The custodial Roth IRA, a tax-free retirement supercharger. And the UTMA/UGMA, the ultimate flexible fund with tax and control considerations. Each one is a specialized tool designed for maximum growth, unburdened by the crippling fees, high commissions, and low returns of a whole life insurance policy. They put your child's money to work in the market, not in the insurance company's pocket. So we have these incredible tools, but how do you actually choose which one is right for your family? And more importantly, how do you avoid the common, costly mistakes that even savvy parents make when setting them up? That's what we'll cover next, with a step-by-step guide to making the right decision. All right, let's break down this decision into a clear, actionable playbook. This isn't about complex financial jargon. It's about a simple three-step framework to determine exactly what to do, and just as importantly, what not to do. Step 1, before you even think about calling an agent or looking at a single policy, is the purpose check. You need to ask yourself one brutally honest question. Why am I actually doing this? Forget what you've heard, forget the sales pitches. What is your number one non-negotiable goal? Is it purely for peace of mind, to cover the unimaginable yet statistically tiny risk of final expenses? If so, your path will be very different than a parent whose goal is to lock in their child's future insurability, no matter what health issues arise later in life. Or is your primary goal to use this as a long-term, tax-advantaged financial tool, a vehicle for building a cash value asset that your child can use for college, a down payment on a home, or even to start a business? Be specific. Write it down, because if you don't know your destination, every road looks like the right one. And in the world of insurance, that's a recipe for overpaying for a product that doesn't fit your needs. Once you have your why, you're ready for step 2, choosing the right vehicle. There are really only two mainstream options to consider, and they serve wildly different purposes. First, you have the child term rider. Think of this as the simplest, most straightforward option. It's not a standalone policy. Instead, it's an add-on, a rider, to your own life insurance policy. It's like adding an extra topping to your pizza. It's cheap, easy, and part of a bigger order. A child term rider typically provides a modest death benefit, maybe $10,000 or $20,000, and it's incredibly inexpensive. We're talking a few dollars a month. The primary purpose here is that first goal, covering final expenses. It's a safety net, pure and simple. The major advantage is the cost. The major disadvantage? It's temporary. It usually expires when your child turns 18 or 25, and there's no cash value, no savings component, no long-term benefit. If your why from step 1 was only about covering that small, unthinkable risk for the lowest possible cost, a term rider is likely your answer. But if your why involved future insurability or building a long-term financial asset, you need to look at the second option, a whole life insurance policy. This is a completely different animal. This is a standalone, permanent policy that belongs to your child. Think of it less like a safety net and more like planting a financial sequoia tree. It starts small, but it's designed to grow for their entire life. It has two key components. First, the death benefit, which is guaranteed to be there forever as long as premiums are paid. This locks in their insurability at a young, healthy age. If they develop diabetes or have a car accident at 22, it doesn't matter. They're already covered, and they can often buy more coverage later without a medical exam. The second component, and the one that gets all the attention, is the cash value. This is a living benefit. A portion of every premium you pay goes into a cash account that grows at a guaranteed rate, tax-deferred. It's like a supercharged savings account, completely separate from the stock market. Over decades, this cash value can become a significant asset. This is the money your child could potentially borrow against to fund their dreams. So the decision tree is simple. Is your goal short-term, low-cost protection? Look at a term rider. Is your goal long-term, permanent protection combined with a financial growth vehicle? You're in the whole life camp. Now for step 3, and this is where most people get tripped up, how to actually buy it without getting taken for a ride. This is about finding the right guide and understanding the map. Your guide is your insurance agent, and the map is the policy illustration. Let's start with the guide. You have two types of agents, captive and independent. A captive agent works for one company. Think of a State Farm or a New York Life agent. They can only sell you their company's products. An independent agent, on the other hand, is a broker. They work with dozens of different insurance companies for a specialized product like a child's whole life policy. An independent agent is almost always your best bet. Why? Because some companies are just better at this than others. They have lower fees, stronger guarantees, and more flexible terms. An independent agent's job is to shop the market and find the absolute best fit for your specific goal, not just the best fit from a single company's menu. When you sit down with an agent, you need to be in the driver's seat. Here are the 5 critical questions you must ask. 1. Can you show me a side-by-side comparison from at least 3 different A-rated insurance companies? If they can't or won't, that's a red flag. 2. Explain the ownership and transfer process to me. When and how does my child take control of this policy? You need to know that you, the parent, are the owner until you decide to transfer it. 3. Walk me through the guaranteed column of the illustration. Let's ignore the non-guaranteed numbers for a moment. Based only on the guarantees, what will the cash value be in 10, 20, and 30 years? This is the most important question. 4. What are the specific rules and any potential costs for accessing the cash value through a loan in the future? Understanding the liquidity is key. And 5. What is the paid-up date? Many of these policies can be structured so you only have to pay premiums for a set number of years, like 10, 15, or 20, after which the policy is paid up for life and continues to grow on its own. This can be a powerful strategy. That brings us to the map, the policy illustration. This is a multi-page document that projects the future of your policy. It will have a lot of numbers, but you only need to focus on 2 columns, guaranteed and non-guaranteed. The guaranteed column is your foundation. These are the numbers the insurance company is contractually obligated to deliver, no matter what happens in the economy. This is your worst-case scenario, and it's the bedrock of your decision. The non-guaranteed column is the icing on the cake. It projects what could happen if the insurance company performs well and pays out dividends. Dividends are not guaranteed. An unethical agent will point only to the shiny, exciting numbers in the non-guaranteed column. A good agent will ground the entire conversation in the guaranteed column, treating the non-guaranteed numbers as a potential, but uncertain, bonus. The biggest mistake you can make is buying a policy based on a fantasy projection. Base your decision on the contractual guarantees. So let's recap the playbook. Step 1. Define your primary why. Step 2. Choose your vehicle. A simple term rider for low cost, temporary protection, or a whole life policy for permanent insurability and cash value growth. Step 3. Find an independent agent and grill them with the right questions, focusing relentlessly on the guaranteed numbers in the policy illustration. By following this framework, you strip away the sales hype and the confusion. You move from being a passive buyer to an informed decision maker. You avoid the critical errors, buying the wrong type of policy, paying too much, or falling for unrealistic promises. You put yourself in complete control of the process. Okay, you've got the playbook. You know the steps and the traps to avoid. But what does this look like 20, 30, even 50 years down the road? What are the real-life stories of parents who made this choice? And what can we learn from them? We tracked down families who did this decades ago, and what they revealed might just change everything you thought you knew about building generational wealth. Meet the Millers. Back in 1995, David and Karen Miller were a young couple living in suburban Ohio. They had a 2-year-old daughter, Sarah, a mortgage they were chipping away at, and the same financial anxieties that keep most new parents up at night. One day, an old-school financial advisor sat down with them at their kitchen table and pitched an idea that sounded strange. A whole life insurance policy not for them but for little Sarah. The death benefit was small, almost an afterthought. The premium was $50 a month, a noticeable amount for them back then. It wasn't about protecting against the unthinkable. The advisor framed it differently. He called it a forced savings account on steroids, a financial Headstart. They could give their daughter that would compound for decades. They were skeptical. $50 a month could go into a savings account or mutual funds. But the advisor pointed to two things: the tax-deferred growth of the cash value and the contractual guarantees that a stock market account could never offer. After weeks of debate, they took a leap of faith. They signed the papers. For the next 20 years, that $50 payment was just another line item in their budget, automatically drafted from their checking account. They rarely thought about it. It was just there. Sarah grew up, did well in school, and got accepted into a great university. That's when the policy had its first moment to shine. A scholarship fell through at the last minute, leaving a $5,000 gap for her junior year. Instead of taking out a high-interest private loan, David and Karen took a loan against the policy's cash value. The interest rate was lower, the terms were flexible, and it didn't affect Sarah's credit. They paid it back over the next couple of years. It was a small win, but it felt significant. The real magic, however, happened a few years later. Sarah, now 27, was a nurse, living in a city where rent was skyrocketing. She was diligently saving for a down payment on a small condo, but felt like she was treading water. The goalpost for homeownership just kept moving further away. That's when her dad remembered the policy. He called the insurance company. After 25 years of consistent payments and compound growth, the cash value had grown to just over $32,000. It was a jaw-dropping moment. That forgotten $50 a month payment had morphed into a substantial asset. Sarah was able to take a policy loan for $25,000, combine it with her own savings, and put a down payment on her first home. She got into the housing market years before any of her friends. Today, Sarah is 31. She's married, the condo has nearly doubled in value, and she and her husband are using that equity to upgrade to a larger house to start their own family. When we spoke to her father, David, his voice cracked a little. He said, "We had no idea. We just thought we were putting a little something away. That $50 a month, it wasn't a sacrifice, but it became the foundation for her entire financial life. It was the single best financial decision we ever made for her." Now let's contrast that with the Jacksons. In 1998, Mark and Susan Jackson of Arizona did something similar for their newborn son, Michael. They also bought a life insurance policy, but their experience turned out to be a world apart. They were sold a type of policy called a universal life policy. On paper, it looked fantastic. It had more flexibility than the Miller's whole life policy. The agent showed them projections where the cash value soared, based on optimistic interest rate assumptions. The key selling point was the flexible premium. The agent told them they could pay a lower, minimum premium if money was tight, and the policy would still stay in force. For a young family, that sounded like a great feature. So for nearly 15 years, that's what they did. They paid the minimum premium, believing they were funding Michael's future. But here's the trap they didn't see. Inside a universal life policy, the cost of the insurance itself increases every single year as the child gets older. When you only pay the minimum premium, you aren't putting enough in to cover that rising cost and build cash value. For the first decade, it seemed fine. But slowly, silently, the rising insurance costs began to eat away at the small amount of cash value that had accumulated. Then, in 2016, they received a letter from the insurance company. It was a bombshell. The policy was projected to lapse, to become worthless, in less than 2 years unless they started paying a premium that was 3 times what they had been paying. They were confused, then horrified. They had poured thousands of dollars into this policy over 18 years. When they checked the cash value, it was less than $1,000. All their contributions had been consumed by internal fees and the rising cost of insurance. Mark told us, "It felt like a betrayal. We thought we were doing the responsible thing, setting him up. Instead, we basically lit money on fire for 18 years. The agent never explained that flexible premium meant we were underfunding the plan. We just saw the low number and thought it was a good deal." The Jackson story is a powerful, painful lesson. The type of policy and how you fund it are everything. Not all life insurance is created equal, and a lack of understanding can turn a tool for wealth into a financial drain. Finally, there's the Garcia family in Florida. Their story isn't about incredible cash growth or down payments. It's about something far more fundamental. In 2002, Carlos and Isabella Garcia bought a simple, straightforward whole life policy for their daughter Maria. Their main motivation was the guaranteed insurability feature. Carlos's brother had been diagnosed with a heart condition in his 20s and struggled to get affordable life insurance. Carlos was determined to make sure his daughter never faced that problem. The policy they bought for Maria included a rider called the guaranteed purchase option. This gave Maria the right to buy additional insurance coverage at specific ages, 25, 28, 31, and so on, regardless of her future health, with no medical questions asked. For years, the policy was just a piece of paper in a file cabinet. Maria was a happy, athletic kid. But at age 19, during a routine physical for college, she was diagnosed with Crohn's disease, a chronic autoimmune condition. It was manageable, but it was a serious lifelong diagnosis. Financially, the timing was devastating. A Crohn's diagnosis at 19 would make getting new, affordable life insurance as an adult nearly impossible. Most companies would either decline her application outright or charge her astronomical premiums. But because her parents had the foresight to buy that policy when she was a healthy child, her insurability was locked in forever. The insurance company could never take her coverage away. And when she turned 25, got her first real job, and wanted to increase her coverage, she simply exercised her guaranteed purchase option. No exams, no questions about her Crohn's disease. She bought another $100,000 of coverage at the standard premium for a healthy 25-year-old. Isabella, her mother, told us, "The cash value is a nice bonus. But that's not what we think about. We think about the fact that when our daughter was facing a scary diagnosis, the one thing she didn't have to worry about was her future financial security. That rider, that little feature we paid a few extra dollars for, turned out to be priceless. It was a gift of peace of mind." 3 families, 3 policies, 3 profoundly different outcomes. The Miller story is the dream scenario, a financial launchpad created through decades of quiet discipline. The Jackson story is the nightmare, a cautionary tale of complex products and misunderstood terms that led to wasted money. And the Garcia story highlights the powerful, often overlooked role of insurance as a protector of something you can't buy later, your insurability. These real-world experiences strip away the sales pitches and the hypotheticals. They show us that this strategy isn't a simple yes or no question. The difference between creating a legacy and a liability lies entirely in the details. These stories show us what's possible, for better and for worse. But they all lead to one final critical question. If you decide this is the right path for your family, what are the exact, non-negotiable steps you must take to avoid the traps and ensure you're building a legacy, not a liability? What are the specific policy features you have to look for? And what are the red flags you absolutely must run from? In our final part, we're cutting through all the noise. We're giving you the ultimate checklist, the definitive guide for parents considering this strategy. This is the information that separates the success stories from the cautionary tales. You won't want to miss it. Alright, let's get straight to it. This is the 5-point parents playbook, the final filter every parent must run this decision through. First, you must define your why. I don't mean a vague sense of wanting to do something good for my kid. I mean you need to get surgically precise. Are you buying this policy for one of 3 core reasons? Reason 1, the peace of mind play. This is purely about covering the unthinkable, the final expenses, medical bills, and giving your family time to grieve without financial pressure. If this is your only why, you need to ask if a simple, inexpensive child rider on your own term life insurance policy would suffice. It often does, for pennies on the dollar. Don't buy a V8 engine when you only need to go to the corner store. Reason 2, the insurability guarantee play. This is a powerful long-term strategic move. You have a family history of juvenile diabetes, heart conditions, or other health issues that could make it difficult or astronomically expensive for your child to get insurance as an adult. By locking in a policy now while they are young and healthy, you are essentially buying them a lifetime of affordable coverage, no matter what health challenges arise later. This is a legitimate and often very wise reason. Your why here isn't about an investment. It's about mitigating a future, known risk. Reason 3. The wealth accelerator play. This is the most complex, most controversial, and highest stakes reason. You see this policy as a tax-advantaged investment vehicle, a rich kid's Roth IRA, a way to build a cash value asset they can borrow against for a down payment on a house, to start a business, or to fund their own children's education. If this is your why, then the entire game changes. You are no longer just buying insurance. You are evaluating a long-term, low-yield, tax-deferred investment product. Your level of scrutiny needs to be 10 times higher, which brings us to point 2. Point number 2 on the checklist. Run the numbers objectively. This is where emotion leaves the room and the cold, hard calculator takes over. Before you even think about signing a check for a premium on a child's policy, you must be able to answer yes to the following questions. Have I, the parent, received the full company match on my 401k? Have I fully funded my own Roth IRA for the year? Have I fully funded my spouse's Roth IRA? Do we have an emergency fund with at least 3 to 6 months of living expenses liquid in cash? Is my own life insurance coverage, the policy that protects my children if I'm gone, adequate to cover the mortgage, college, and their entire upbringing? Think of your family's financial health like building a skyscraper. The foundation is your emergency fund and your own insurance. The structural beams are your retirement accounts. The upper floors are college savings and other investments. A cash value life insurance policy for your child? That's the penthouse suite. It's a luxury edition. And you would be insane to start construction on the penthouse while the foundation is still a pit of mud. If you are sacrificing any of those foundational financial goals to pay the premiums on a child's policy, you are not making a smart financial move. You are engaging in financial malpractice against your own family. Third on the playbook. Vet the policy, not the sales pitch. The brochure will show you beautiful, hockey stick-shaped graphs of future wealth. The agent will talk about guarantees and tax-free loans. Your job is to ignore all of that and become a forensic accountant. You need to demand the policy illustration and look for 3 hidden killers. First is the growth engine. Ask for the guaranteed cash value growth rate. This is the number the company is legally bound to deliver. It will be low, probably around 2 or 3%. Then look at the non-guaranteed projections. These are based on dividends or market performance. Ask for the company's dividend history. A company that has paid dividends consistently for 100 years is a much safer bet than one that hasn't. But never forget, the non-guaranteed portion is just that, a projection, a hope, a marketing tool. Second, and this is the most important, is the fee structure. Fees are the silent cancer of investment returns. You need to ask point blank, what is the total cost of this policy over the first 10 years? Ask about surrender charges. These are massive penalties if you need to access your money or cancel the policy in the early years, often lasting 10 to 15 years. Ask about the administrative fees, the mortality and expense charges, and the agent's commission. A high commission product means less of your premium dollar is actually going to work for you. A policy that looks great on paper can be bled dry by 1,000 tiny fee cuts. Third is flexibility. Life happens. What if you lose your job and can't make premium payments for a year? Does the policy lapse? Can you use the existing cash value to cover the premiums? How easy is it really to take a loan? What are the interest rates on that loan? A rigid policy is a fragile policy. You want a contract that can bend without breaking. Fourth on our checklist, compare it to the alternatives. This is the opportunity cost test. The question isn't, is this a good place for my money? The question is this the best place for my money? So, you do a simple thought experiment. Let's say the premium is $100 a month. $100 a month for 18 years. Option A is the life insurance policy. After 18 years, you might have, let's say, $25,000 in cash value plus the death benefit. Option B is putting that same $100 a month into a $529 college savings plan. The money grows tax-deferred and can be withdrawn tax-free for qualified education expenses. Assuming a conservative 7% average annual return, that $100 a month becomes over $41,000. Significantly more money for its intended purpose. Option C is putting that same $100 a month into a custodial brokerage account, an UTMA or UGMA, invested in a simple S&P 500 index fund. Again, assuming a 7% return, you're looking at that same $41,000. It will be subject to capital gains tax, but it offers total flexibility. The child can use it for college, a house, a business, anything. When you see the numbers side by side, the life insurance policy's growth looks anemic in comparison. You have to ask yourself, is the death benefit and the guarantee of future insurability worth the $20,000 or more in potential growth that you are giving up? Sometimes the answer is yes, but you cannot make that decision until you've seen the raw mathematical comparison. Finally, point number 5, the exit strategy. Buying the policy is not the end of the plan. It's the beginning. You need a strategy for the day you hand this asset over to your child. When does that happen? At age 21? 25? When they graduate college? Who pays the premiums then? If you stop paying, will the policy sustain itself with its own cash value? More importantly, how will you educate them? Handing a 21-year-old a life insurance policy with $50,000 in cash value without any financial education is like giving a toddler a loaded gun. It's a financial tool and they need to be taught how to use it. You need a plan to sit them down and explain what it is, how it works, and the responsibility that comes with it. This isn't a gift card. It's the first block in their own generational wealth structure. A legacy without a lesson is just a lottery ticket waiting to be squandered. So let's bring it all home. What's the final verdict? Here it is. Life insurance for a child is a green light. A smart move for a very specific type of person. You are a high-income earner. You have already maxed out every other tax-advantaged retirement and investment vehicle available to you. You have a high net worth and are looking for ways to pass money to the next generation in a tax-efficient manner. For you, it's a diversification tool, a component of a much larger, sophisticated estate plan. It is a hard red light, a financial trap for the vast majority of American families. If you are struggling to fund your own retirement, if you don't have a robust emergency fund, if you're choosing between this premium and a $529 contribution, stop. Do not pass go. You are putting the penthouse before the foundation. Your primary duty is to secure your own financial future, so you don't become a burden on your children later. A well-funded $529 and a custodial brokerage account will almost always serve the average family better. The question we started with was never just, is life insurance for kids a good idea? The real question, the one that truly matters, is it the best idea for your money with your goals right now? After 10 parts, the power to answer that question is now completely in your hands. It's not about what an agent promises you. It's about what your own financial blueprint proves to you. Protect your family, build your wealth, and make the decision that lets you sleep soundly at night. Because that, right there, is the ultimate return on any investment.